Tyler, I think what the bond market has been doing over the last several months and this week is just pricing in slower global growth. The U.S. was growing at 3% last year. We're now growing at 2%. Inflation is low, but most importantly, this trade war with China and the heightened potential war with Mexico could really cause the U.S. economy to grow below potential. So we're trending right now at 2% growth, but the downside risks have increased materially. And so the market's now priced for 50 to 75 basis point of rate cuts by the end of this year.
Is recession a risk?
Tyler, I don't think recession is a risk right now because the consumer and businesses are pretty healthy. The consumer, 68% of the economy, low rates are going to support the consumer, the job market, et cetera. What we worry about, though, is an extended trade war with China, this going into the Mexico trade war. That could really significantly hurt business sentiment. You're going to start to see, I think, job growth slow materially, particularly if the trade is not resolved with China. That will, in turn, slow the manufacturing sector. So I do think the recession risks are going up pretty significantly.
The market seems to expect rate cuts, plural. Do you?
We think if President Xi and President Trump don't meet at the G20, and if we don't see progress with the U.S.-China trade front, and we see the tariffs go into effect with Mexico, we think actually the Fed could cut as soon as July. So basically, it's going to depend a lot on trade. It's very much motivated now about uncertainty and what happens politically. But if this extended trade war is not resolved, then yes, I think the Fed could cut as soon as July, and I think they'll go 50 basis points.
Mark, your latest, or Pimco's latest global outlook was very bearish on credit. It was released at the end of May. What needs to happen in order for that bearish scenario to not play out? If rate cuts happen, could that actually help things in terms of companies being able to service their debt?
So, Melissa, it could help near term just in terms of changing sentiment, and we could get a near-term relief rally. But what we're worried about is longer-term politics, populism, this deterioration in the U.S.-China relationship. These are long-term secular issues that aren't going away. So we actually think, given where valuations are, we think equities are on the richer side. We think credit spreads are quite tight, particularly given the fact that we think recession risk is increasing. So any rally in risk assets, we would look to de-risk portfolios, and we have been, in fact, on the more cautious side of markets, particularly equities and credit.
Let me make sure I understand what you just said very clearly. If there is not progress on trade between the United States and China at the G20 meetings later this month, if the tariffs go into effect sort of undampened, unmitigated on Mexico, you expect the Fed to cut rates by a half point in July.
That's certainly possible, Tyler. And I think the other thing we have to factor in is, will the tariffs on Mexico escalate and go up above 5%? Trump has talked about that going to 25%. I think if we got the initial 5% and then Congress started to put pressure on Trump and that's all we got, then perhaps we're set up for the Fed to be on hold. But if we get escalation of those tariffs with Mexico, then I think the business uncertainty will increase materially. There's going to be, by the way, significant winners and losers in the credit and equity sector. Autos is a sector we're quite cautious on, and this trade dispute with Mexico and China makes us even more cautious there.